Welcome to the tutorial on amalgamation. In this tutorial, we are going to learn about the journalizing process of amalgamation. That means we are going to journalize the amalgamation process. From the previous tutorial, we have learned that there are two types of method of accounting for amalgamation. The first method is pooling of interest method and the second method is purchase method. Pooling of interest method, already we are aware that we apply the pooling of interest method when the amalgamation occurs in the nature of merger. And we already know that amalgamation of merger will be considered when all the 5 conditions stated before are satisfied. However, in this slide, we are going to learn the characteristics of pooling of interest method. Under this pooling of interest method, it is considered that the amalgamation is a non-event. That means the combining companies are viewed as if they always had been together. Second characteristics we can see, all the assets and liabilities are carry forward at a book values, as well as we also carry forward the retained earnings. The third characteristics is no goodwill is recorded. And the fourth characteristics is the costing or expenses arises from the amalgamation process are not capitalized. Number fifth characteristic is that we carry forward the retained earnings because we will consider the retained earnings as a source of dividend payments by the new company. This slide is the details explanation of the previous slide. We can see in this pooling of interest method, we need to do some consideration. We can see all the assets and liabilities and reserves are carry forward or recorded in the carrying amounts or book value, and the reserves appear in the transferee company because this reserve will be considered as a source of dividend payment. And here is the important thing, the difference between the amount recorded as share capital issued plus any additional consideration in the form of cash or other assets and the amount of share capital of the transferor company is adjusted in the financial statements of the transferee company. This is an important issue. We will discuss it details whenever we are exercising a practical problem. No goodwill is recorded and the balance of profit and loss account is shown in a aggregated way, and you can also show this profit and loss account as a general reserve. This slide we are going to show what are the journal entries should be made in the book of transferee company. Transferee company is a new company. There are 4 types of journal. The first journal is for the amalgamation of the business. The debit is business purchase account. We will debit this account with the purchase consideration amount. The credit will be liquidator of transferor company. Here transferor company means the company which will be dissolved or liquidated or which will be vanished. In the second journal, we will make entries for the assets, liabilities and resources taken over. So since we are making journal entries for the transferee company, in this company we will take over all the assets and liabilities of transferor company. In the debit side, we will show all the assets taken from the transferor company, and in the credit side, we will show all the liabilities, and we can see the reserve account. In this reserve account, we will show the difference between the actual capital plus actual reserve minus the purchase consideration. The difference will be shown as reserve account, and profit and loss account in the credit side and business purchase account with the purchase consideration should be shown in the credit side. This journal will be made on all the assets and all the liabilities and reserve and business purchase account. And the third journal, we will make an entry for payment of purchase consideration. In that case, liquidator of transferor company account debit. That means liquidator of transferor company means the company which will be dissolved or liquidated. And share capital account credit, and this journal will be made with the amount of issued capital. And if there is a issuance of premium, then we will show, otherwise we should not show it. And if we pay any cash for any fraction share, we will show as a credit. And if we provide any non-cash consideration, we will show in the credit side. In the fourth journal, we will journalize for the issuance of debentures to the debenture holders by the transferee company. In that case, we will debit the debentures in transferor company account debit and debentures account credit. So these are the journal entries which should be made in the book of transferee company. Again, transferee company means the company which will be newly created. In this slide, we are going to learn about the journal entries for transferor company. Transferor company means the company which will be liquidated or which will be dissolved. The first journal should be for transferring the assets, second journal for the transferring liabilities, and the third journal for transferring equity. Since we are journalizing for transferor company, we should keep in our mind that we are going to banish the items of this company. That's why we need to show all the assets in the credit side, because we need to banish this assets account. And generally we know assets is debit item, but since we are liquidating this company, or we are going to dissolve this company, or we are going to banish these items, that's why we will show the asset item in the credit side. Although asset item is a debit item, but since we are going to liquidate this company, that's why we will show in the opposite direction of the items. Asset will be shown in the credit side because we are going to remove all the assets item, and the realization account will be debit with the total amount in the credit side. And this realization account is a temporary account. We will use this account for a short time. I mean, after completing the amalgamation process, this account will be removed by the debit credit process. In the second journal, we will show all the liabilities in the debit side. Generally we know that liabilities are the credit item, but since we are going to banish the items of transferor company, that's why for removing this item we will show in the debit side. So all the liabilities in the debit, and with the total amount of all liabilities we will show the realization account credit side. Again I am reminding, this realization account is a temporary account. Just we are using it for completing the journalizing process. After completing the journalizing process, this account will be vanished, because debit credit it will be removed whenever we will prepare a ledger. In the third journal entries, we will show the journal for transferring the equity, share capital, reserve and profit and loss, which is also known as surplus. Generally equity, reserve, these are the credit item, but we will show in the debit side because we are going to remove this item from the transferor company. Equity share debit, reserve debit, profit and loss debit. And against this capital, reserve and profit and loss, there will be a issuance of share. That's why sundry shareholders account credit. These are the three items. There are another journal entries for transferor company. In the next slide we are going to show. So in the fourth journal, we will make journal entry for transferring any preference share. If there is any preference share, then preference share will be debit, because again I am reminding, we are journalizing for the transferor company, the company which will be liquidated. That's why, although this is a credit item, but we are showing it in the debit side because we are going to remove this by doing this journalizing process. So however, preference share capital debit and preference shareholder account credit, because ultimately the transferee company will provide preference share. That's why it will be shown in the credit side as a shareholders account. Fifth journal entry will be with the purchase consideration. In this journal entry we will show transferee company account in the debit side and realization account in the credit side with the purchase consideration amount. In the sixth journal entries, we will journalize for receiving any shares and other things. So if we receive any share, then we will show it as a equity shares in transferee company, preference share in transferee company, debenture in transferee company, and transferee company account credit side. In the 7th journal, we will show any loss or profit from the realization. If there is a loss, the journal will be sundry shareholders account debit and realization account credit. But if there is a profit, there will be opposite journal, realization will be debit and sundry shareholders account will be credit. Finally, we have to make a journal entries for final payment, that is sundry shareholders account debit and equity shares in transferee company account credit. To get a clear idea about this journalizing process, we need to show a practical problem with a solution. Let's see the problem and solution of journalizing the amalgamation. Here we can see the problem. The following are the financial position, I mean the balance sheet as on 31st March 2020 of X Limited and Y Limited. In this problem, we are going to liquidate these two companies, X Limited and Y Limited, and we will create a new company that is called Z Limited. Okay. So from the financial position, we can see the liabilities and equities. These are the equities, and these are the long-term liabilities and current liabilities of X company and Y company, and these are the assets, non-current asset and current asset of X company and Y company. Besides this balance sheet, there will be a information regarding the amalgamation process. Here we can see in April 2020 the two companies agreed to amalgamate and form a new company called Z Limited. That means these two companies are going to be dissolved or liquidated, and there will be a new company that is called Z Limited, which takes over the assets and liabilities of both the companies. The authorized capital of Z Limited is Taka 10 lakh, consisting of 1 lakh equity shares of 10 Taka each. That means the per share price of Z Limited is Taka 10, and the purchase consideration is agreed at Taka 1,20,000 and Taka 60,000 for X Limited and Y Limited. That means Z Limited will provide purchase consideration of Taka 1,20,000 for the X company and Taka 60,000 for Y company. The entire purchase consideration is to be paid by Z Limited in its fully paid shares. This purchase consideration will be provided by issuing shares. In return for debentures in X Limited, that means there are some debentures in X Limited, 6% debentures, 20,000. These debentures will be paid by the X Limited with the same amount, and denomination are to be issued by the Z Limited. That means these 20,000 debentures will be issued by the Z Limited for the debentures in X Limited. However, we can see the purchase consideration for X company is Taka 1,20,000, and that will be paid by issuing shares, and for Y Limited by issuing shares of Taka 60,000. The requirement in this problem is give journal entries to close the books of X Limited and Y Limited and to show the opening entries in the book of Z Limited. So this X Limited and Y Limited will be liquidated and Z Limited will be created. We need to provide closing entries for the X and Y, and we need to provide opening entries. Entries mean journal. So opening entries for Z Limited, and as well as we need to prepare a financial position of Z Limited, because this is the newly formed company. We need to prepare a financial position, I mean the balance sheet or financial position for Z Limited. Again I am repeating, this is the balance sheet or financial position of X Limited and Y Limited. From this balance sheet and from this information we are going to journalize the amalgamation process. In this amalgamation, Z company will be newly created and X and Y will be liquidated. This is the solution. We can see journal in the book of X Limited. Here X Limited will be liquidated. In this journal book, we are going to journalize the amalgamation. I would like to remind you that this X company will be taken over by the Jet Limited. That's why we can see in the first journal all the assets of X Limited are shown in the credit side. Since this company will be liquidated, that's why these accounts should be removed. For that purpose, we have shown all the assets in the credit side. This is the question we can see here. These are the item of X Limited, and from this item, these are the assets of X Limited. Here we can see land and building 30,000, plant and machinery 110,000, short-term investment, there is no short-term investment, inventories 16,000, accounts receivable 14,000, cash and cash equivalents 3,000. These are the assets of X Limited. We are going to show these assets in the credit side because we are going to liquidate this X Limited. Although these assets item are debit item, but we are showing in the credit side for the purpose of liquidating this X company by removing this account. If we show the debit item in the credit side, it will be vanished or it will be removed from the accounts. Here we can see land and building, plant and machinery, inventories, account receivable, cash and cash equivalents. So these are the amount. The total amount is 1,73,000. That's why this total amount will be shown as a realization account. This is a temporary account. We are using this account for a temporary purpose, for a short-term use. We have provided one journal for X Limited. In the second journal, we have shown all the liabilities in the debit side. We already know that liabilities are credit item, but we are showing it in the debit item because this company will be liquidated. That's why this account should be removed from the accounts. That's why liabilities are shown in the debit side. From the question, we can see these are the liabilities of X Company Limited. 6% debentures 20,000, accounts payable 10,000, and current liabilities 3,000. These are the liabilities item. For the purpose of liquidating, they have been shown in the debit side. With the total amount, we are showing the realization account in the credit side. This is the 20,000, 10,000, 3,000, total 33,000. This is realization account. First journal, we have shown all the asset in the credit side because this company will be liquidated, and all the liabilities have been shown in the debit side in the second journal. And in the third journal, we will show all the equities item in the debit side because this is the X company, the company which will be liquidated or dissolved. That's why the accounts will be removed from the accounts. These are the parts of equity. Here you can see share capital, reserve, dividend, equalization fund, profit and loss account. If we see the question, here is the question. We can see these are the parts of equities: share capital 1 lakh, reserve 34,000, dividend equalization fund 4,000, profit and loss account 2,000. These are the equities. Since we are going to liquidate this company, these are the credit item, but we are showing in the debit side because we are removing by doing that type of journal. And the total amount of these equities is 1,40,000. The credit item will be sundry equity shareholders account 1,40,000. The X company has the equities of total 1,40,000. And in the fourth journal, we will show the entry for recording the purchase consideration due from Jet Limited. From the question, we can see the purchase consideration is agreed at Taka 1,20,000 for X company, and this purchase consideration will be taken from the Jet Limited. This is the newly company, but we are doing journal for the liquidating company or transferor company, the company which will be dissolved or which will be liquidated. So purchase consideration will be received from Jet Limited, that's why Jet Limited debit 1,20,000, and realization account will be credit with 1,20,000. This journal is for the purchase consideration due from Jet Limited. And the next journal should be for the loss from the realization. We can see the X company is providing equity item of total 1,40,000, but it is receiving purchase consideration of taka 1,20,000. So there is a loss of 20,000. That's why sundry equity shareholders will be debit with the loss amount and realization account will be credit with the loss amount. Why there is a loss? Because X company is providing 1,40,000 equity item, capital, reserve, dividend equalization fund, profit and loss account or retained earnings. But they are receiving purchase consideration up to 1,20,000. 1,40,000 is the providing items, but they are receiving 1,20,000. That's why there is a loss. Loss for the X company, that means the company which will be liquidated. That's why this loss will be journalized as sundry equity shareholders. We know that it's a credit item, but there is a loss. That's why we are showing it in the debit side, and in the credit side we will show the realization account. And in the next journal we will record the purchase consideration received. Whenever we are receiving the purchase consideration from Jet Limited, Jet Limited account is shown in the credit side, and as a purchase consideration the X will receive the shares of Jet Limited. That's why shares in Jet Limited debit. And this journal will be inversed here. Whenever there is a distribution of shares in Jet Limited, this account will be shown in the opposite side here, and the sundry equity shareholders will be debit side. So these are the journal entries in the book of transferor company. I mean here the X company, because this company will be dissolved or liquidated, or the items of this company will be vanished by the journalizing process. That's why we have shown all the items in the opposite side. These are the journal entries in the book of Y Limited. This is another company which will be liquidated. In the same process, here all the assets have been shown in the credit side because this company will be liquidated or removed or dissolved. This is the question. We can see these are the asset item: plant and machinery 50,000, inventory is 8,000, account receivable 9,000, cash and cash equivalents 1,000. These are the asset item of Y Limited. These are the debit item, but we are showing it in the credit side for the purpose of removing this item from the accounts of Y Limited, because Y Limited will be liquidated. A new company will be created, that is Jet company, and Y company and X company will be liquidated. The assets have been shown in the credit side, and the total amount is 68,000, 50,000, 8,000, 9,000, 1,000, total 68,000, and this 68,000 will be shown as a realization account. This is a temporary account. We can see these are the liabilities for Y company limited. Let's see the question. We can see from the question the liabilities item of Y company is only 8,000, accounts payable. That's why in the journal entry we have shown the liabilities in the debit side. Again I am repeating, we are showing it in the debit side because this company will be liquidated. That's why this account will be removed by showing it in the opposite side. It's a liability item, it's a credit item, but we are showing it here in the debit side because these are the item will be taken over by the new company, that is Jet company. This is the journal entry for the liabilities. For the Y company, there is only one item, liability. So this is debit, and realization account credit. After that, the equity items, there is only one equity item. Let's see the question. This is the question. We can see Y Limited has only one equity item, that is called capital. That's why in the solution of journal entries, we have shown it in the debit side, taka 60,000. Equity capital is a credit item, but we are showing it here in the debit because this company will be removed. And in the credit side, we can see Sunday equity shareholders account 60,000. In the next journal entries, we will record the purchase consideration due from Jet Limited. From the question, we can see the purchase consideration is taka 60,000 for Y Company Limited. That's why we have shown this. There will be a purchase consideration from Jet Limited with 60,000, and the credit is realization account 60,000. We have seen that in the X Company Limited there was a loss due to realization account, but in case of Y Limited there is no loss because they have provided equity of 60,000 and they have received purchase consideration for 60,000. So there is no profit, no loss. That's why this journal is not applicable for Y Limited, although we have shown a same journal in the X Company Limited, but since there is no profit or loss for the Y Company Limited, that's why we should not provide any journal entry for the loss or profit in the journal book of Y Limited. Then in the next journal, we will record the purchase consideration received, and this purchase consideration will come from the Jet Company Limited. We can see Jet Company is debit with the purchase consideration of taka 60,000. We will show it here in the credit side, and on the other hand we will get shares from Jet Limited, which will be shown in the debit side. And the next journal, this item will be shown in the credit side to record the distribution of shares in Jet Limited, and debit will be Sundry equity shareholders account. These are the journal entries in the book of Y Limited. Y Limited is the company which will be liquidated. We have seen the journal entries for X Company Limited and Y Company Limited. This X and Y both are the transferor company. Transferor means the company which will be liquidated or dissolved. Now we will show the journal entries for Jet Limited. This is a newly created company. So in this newly created company, by the process of amalgamation, there are 4 types of journal. In the first journal, we have to record the amalgamation. In the credit side, we will show that X and Y will be liquidated. That's why liquidator of X Company Limited with the amount of taka 1,20,000 and liquidator of Y Limited with 60,000, and the total amount is 1,80,000. That's why the debit item will be business purchase account debit 1,80,000. And in the second journal, since Jet Limited is going to take over 2 companies, in the second journal we will show all the assets and liabilities and equities of X Company Limited. These are the asset item. Asset should be shown in the debit side. This item taken from the X Company Limited: land and building 30,000, plant and machinery 1,10,000, inventories 16,000, accounts receivable 14,000, cash and cash equivalents 3,000. These are the asset item. And the liabilities item, we can see debentures 20,000, accounts payable 10,000, other current liabilities 3,000. These liabilities are taken from the X Company Limited. From the question you can see, this is the question. We can see these are the liabilities. These liabilities will be shown in the credit side, and these are the asset. This asset will be shown in the debit side of Jet Limited. In the general reserve, we have to show the share capital plus old reserve. These 2 items should be added, and we should deduct the purchase consideration to get the general reserve, which should be shown in the Jet Limited, and these are the part of equity of X Company Limited. Let's see the question. Here is a question we can see. The first one is dividend equalization fund 4,000, profit and loss account 2,000. This will be shown in the credit side of Jet Limited. Here these two items have been shown in the credit side, and ultimately business purchase account with the purchase consideration amount 1,20,000. This will be shown in the credit side. These are the debit item, all the assets, and these are the credit item, liabilities, equities, reserve, and business purchase account, I mean the purchase consideration amount. And in the third journal, we will take all the assets and liabilities of Y Company Limited. All the assets have been shown in the debit side. All the liabilities, here only one liability, have been shown in the credit side, and business purchase account, which is the purchase consideration, in the credit side. And in the next journal, we are going to provide the equity share to the liquidator of X and Y Company Limited. X company will receive share of taka 1,20,000, Y company will receive share of taka 60,000, and they will receive total 1,80,000 share. And these are the another item. Sometimes if the Jet Limited take the responsibility of the debentures, then this journal should be provided. This debentures is taken from the X Company Limited. Let's see the question. 6% debentures 20,000. This debenture is from X Company Limited. 6% debenture in X Company Limited, 20,000 debit. 6% debenture, they are going to take the responsibility of this debenture. That's why this is credit 20,000. So these are the journal entries in the book of Jet Limited. This is a newly created company. So we have done all our journals. Now we are going to show how to prepare the financial position of Jet Company Limited. This is the newly created company. Here equity share 1,20,000. This is the total item 1,20,000 and 60,000. Total 1,80,000 is the equity capital. This is the reserve we have shown. We have shown it here in the book of Jet Limited. This is the newly created company. General reserve 14,000. This reserve should be shown in the balance sheet. This is the general reserve. These are the combined item from X and Y. The dividend equalization fund is taken from the X Company Limited 4,000, and profit and loss account 2,000 from X Company Limited, because there is no item from Y Company Limited. Let's see the question. This is the question. These two items only available in the X Company Limited, so there is no need to combine. And in the debentures we can see only one item 20,000. So here debenture 20,000, and in the current liabilities we can see 18,000 and 3,000. This is the combined amount 10,000, 8,000. Accounts payable total 18,000, and current liabilities only 3,000. Accounts payable 18,000 and current liabilities 3,000. Here total liabilities and equities is 241,000. And in the asset item we can see land and building 30,000. Let's see the question. Here we can see land and building only from X Limited 30,000. This land and building 30,000, and we can see plant and machinery 1,60,000. From the question we can see plant and machinery from X Limited 110,000 and Y Limited 50,000. Total 160,000, 1,60,000. This is the plant and machinery 1,60,000. On the other hand, short-term investment, maybe there is no short-term investment from any company. And inventory is 24,000. From the question we can see inventory is 16,000 from X Limited and 8,000 from Y Limited. Total 24,000. Here we can see 24,000. And account receivable 23,000. From the question we can see account receivable 14,000 and 9,000. Total 23,000. And cash equivalent 3,000 and 1,000. Total 4,000. Here account receivable total 23,000, cash and cash equivalents 4,000. So we can see account receivable 23,000, cash and cash equivalents 4,000. There is the combined financial position of Jet Limited. Jet Limited is the newly created company. We have shown this amount by combining the amounts of X and Y, and in this way we will create the combined financial position for the Jet Limited company. We can see here total liabilities and equities 2,41,000 and total asset 2,41,000. Thank you.